Happy Monday, everybody. Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's #2 economy. My name is Tony. Let's jump in. Now, today's video will be solely about major economic updates in China. We begin with the sort of good before moving to the bad, and then finally, the ugly. China's prolonged property slump shows tentative signs of easing as home price declines moderated for the third consecutive month in November. New home prices in 70 major cities dropped by just 0.2% from October, marking the smallest decrease in 17 months, according to the National Bureau of Statistics. Similarly, used home prices fell by 0.35%, the least since May 2023. These figures offer a glimmer of stabilization after more than 3 years of downturn in the country's critical housing sector. Now, of course, this is very much trying to find a silver lining. The prices are still declining, just at a slower rate. The easing declines come amid increased efforts by policymakers to support the real estate market. General Secretary Xi Jinping and top officials pledged at the recent Central Economic Work Conference to stabilize the property sector next year. However, the lack of specific new measures underscores the fragile nature of the recovery. Fitch Ratings noted that sustaining a rebound in home sales remains crucial for preventing future price erosion. Despite the modest improvement, challenges persist, particularly in smaller cities where inventory levels remain high. November's year-on-year figures reflect the struggle, with new home prices down 6.1% and used home prices declining 8.5%. though both metrics improved slightly from October. Private data shows that sales by the 100 largest real estate firms fell 6.9% year-on-year in November, reversing a brief uptick seen in October. Analysts at UBS predict further declines in property sales, with potential stabilization in Tier 1 cities only occurring sooner than in smaller markets. Fitch projects a 5% drop in new home prices next year, highlighting the challenges ahead despite the government's optimistic growth target of 5% for 2024. Now, this is where the somewhat good news ends. Next up, we have the bad news and then the ugly. Today, Monday, the National Bureau of Statistics published official numbers for November. Now, some will refuse to take official statistics seriously, but the fact that they are mostly disappointing, and in some cases quite poor, is in of itself very telling. Retail sales, a proxy for consumption, slowed to 3% in November, down from 4.8% in October, and missing a UK-based Reuters forecast of 4.6%. The slowdown follows the boost from the Singles Day shopping festival in October, which came earlier this year. Weak consumer confidence and sluggish demand remain hurdles for the world's second-largest economy. In contrast, industrial production was up 5.4% in November compared to a year ago. Michelle Lam, Greater China economist at Société Générale SA, expressed on the numbers, quote, "The data show that the recovery in domestic demand has remained sluggish, while the stabilization in industrial production was likely due to some order front-loading ahead of US tariffs and is not sustainable." End quote. The property sector's woes continue to weigh heavily on growth too, based on the data published today. Real estate investment fell by 10.4% year-on-year for the January through November period, deepening from the 10.3% decline recorded in the previous month. Despite Beijing's stimulus efforts, including loosening property purchase rules and interest rate cuts, the sector shows limited signs of recovery. Indeed, we just covered the only bright spot in this sector. Fixed asset investment, a key indicator of infrastructure, manufacturing, and property spending, rose by 3.3% year-on-year in the first 11 months of 2024, slightly missing expectations of 3.4%. Chang Shu and Eric Zhu of Bloomberg Economics expressed in a note today, quote, "The persistent softness in activity points to the need for more policy support. Strong statements of intent from the Politburo and Central Economic Work Conference have signaled this is coming immediately." End quote. We will have to see, but markets are not particularly impressed. The CSI 300 index of onshore stocks fell after the data release to trade as much as 0.6% lower. The benchmark 10-year yield extended a decline, falling 6 basis points on the day to a record low of 1.72%. The currency was steady in both onshore and offshore markets. Now, before we move to the final update on the economy, if you're enjoying today's episode, don't forget to hit the like button. Liking, sharing, and subscribing is a tremendous help. But up next, first, we have this month's sponsored feature. Sponsored features are limited to just 1 to 2 times per month so that the channel is financially sustainable but relies primarily on subscriber support. If you'd like to know how I work with sponsors, this information is in the description below. President-elect Donald Trump posted the following statement: "The idea that the BRICS countries are on the move away from the dollar while we stand by and watch is over. In the Trump era, currency wars will be fought and a war between fiat currencies to shine a light on gold and silver. That's why today a new sponsor in the silver sector is being profiled, perhaps the top silver stock for the next year. And now is the time to talk about it right before the Federal Reserve meeting on December the 18th. The company's name is VZLA Silver, trading on the New York Stock Exchange with the ticker VZLA, and there are a number of analysts already covering this fantastic company. And compare these to the current price of less than $2. Why are many bullish on silver going into 2025? In each of the previous times that this chart was above the red line, let alone where it is today, silver soared. Look at 1971, 1975, 1986, and 2001. Today, we are 3.5 standard deviations above normal, and the price of silver is indeed trading at multi-year highs, but nowhere near its all-time highs, both nominal or inflation adjusted. Gold and silver are not popular at all, yet after a generation of investors concentrated in big tech, with globalization taking steps back, and with countries scared about their commodities supply chains, VZLA Silver is advancing a project in Mexico that is projected to start production in the first half of 2027 in 2 years' time. This makes it potentially one of the nearest term newest silver mines in the world. And not only are the analysts bullish about VZLA Silver, but the company's largest shareholders are Wall Street titan Franklin Templeton, with over $1 trillion under management, Sprott Inc., and Eric Sprott himself. With 12% ownership, Franklin Templeton has 60 million in VZLA shares. One of the reasons VZLA Silver is such a high-quality company is that while the average peer spends $17.56 to produce 1 ounce of silver, Panuco, the company's flagship asset, has an all-in sustaining cost of only $9.40. That is significantly cheaper than the average, and that is a clear competitive advantage. Mike Pettingell, Senior Vice President of Business Development and Strategy, emphasizes the project's robust economics, expressing, "The NPV to CapEx ratio puts us into a league of our own here." But the cherry on top is in this graph. What it shows is that Panuco can produce 15.2 million ounces of silver equivalent per year, making it the largest undeveloped mine in the world. VZLA Silver has established a clear and methodical path toward production at Panuco, backed by a strong financial position with over $90 million in cash and no debt. Global silver demand is forecast to reach 1.2 billion ounces in 2024, which would mark the second highest level on record, according to the Silver Institute. VZLA is currently valued at 0.49 times price to NAV, while the producers are valued at 1.28x. In other words, in the next 2 years, as the company advances towards production, on paper, the revaluation from 0.49 to 1.28 represents an upside potential of 191%. As such, this is an exciting opportunity for consideration. A speculative move, risk, but also a lot of space for potential returns. We remember that all investment involves risk. This sponsored feature is not individual investment advice. Always speak to an investment professional and do your own due diligence before making any investment decision. A big thank you to VZLA Silver Corp for sponsoring this episode of China Update. Okay, we now return once again to regular content. According to official data published over the weekend, China's aggregate financing, that is total debt in the system, rose by 2.34 trillion yuan in November, up 7.8% year on year. Peking University Professor of Finance Michael Pettis published a note in response to these data, explaining their implications. It's worth quoting at length, as the implications are significant. Quote, "While some analysts note that this is a record low rate of growth, it must be compared with nominal GDP growth, which is also at a record low rate. The country's debt burden continues to rise rapidly, in other words. By the end of November, the outstanding amount of aggregate financing was 405.6 trillion yuan, or approximately 309% of China's annual GDP. At the end of last year, it amounted to 300% of China's GDP. Year-to-date, aggregate financing rose by more than 29 trillion yuan, which means that it took an increase in debt equivalent to nearly 25% of year-to-date GDP to boost nominal year-to-date GDP by less than 4 percentage points. In the pre-COVID years, it generally required 3 to 4 units of debt to generate each unit of GDP growth. This year and last year, it is taking more than 6 units of debt, which suggests that growth in China's economy is more reliant than ever on debt. There is still a few analysts, although a rapidly dwindling number, at least in China, who don't think China has a serious problem of overinvestment in infrastructure and increasingly manufacturing. But with most of the increase in Chinese debt directed towards investment, if Chinese investment were actually productive for the economy, there is no way that the associated debt could rise so much faster than GDP for such a long period of time. This is just arithmetic. That's why I've argued for many years that because the only way China can meet unrealistically high GDP growth targets, i.e. far higher than the real economy can deliver, is to increase non-productive investment under soft budget constraints. The result must be a worsening of the debt burden. This non-productive investment boosts what we call GDP, but as we learned from Japan in the 1980s and Brazil in the 1970s, it does not result in higher value creation, with the rise in the debt burden being a proxy for the gap between the two. This continues to be the case as long as most debt is directed to the supply side of the economy. A surge in the country's debt burden is prima facie evidence that non-productive investment drives much Chinese GDP growth, the result of which will eventually be reversed. End quote. And when that reversal happens, it means the end of China's growth story. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Monday, have a productive week, and I will see you all tomorrow.